Imagine waking up tomorrow morning. You grab your coffee, you check your email, and there it is. Your mortgage application has been denied. No late payments, no collections, no bankruptcy. Yet your credit score just crashed from 780 to 610. You didn't miss a payment. You didn't max out a card. You didn't do anything obviously wrong. So what happened? Here's the uncomfortable truth Americans are learning in 2026. Credit scores don't punish mistakes. They punish patterns. Banks aren't grading your past. They're predicting your future. And right now, millions of Americans are accidentally signaling risk. Inflation pushed groceries higher. Car insurance doubled in some states. Auto loans crossed record interest rates. The average new car payment? Nearly a second rent check. Meanwhile, home ownership, the American dream, feels like a locked door. And your credit score? It's the key. Because here's the cost nobody talks about. A borrower with a 780 score might get a 6.2% mortgage. A 610 borrower? Closer to 8.5%? That difference on a $400,000 home? Over 30 years? That's more than $230,000 extra paid in interest. Not because you earned less, not because you worked less, but because a computer decided you were risky. The scoring model created by Fair Isaac Corporation, the company behind the FICO score, analyzes thousands of behaviors. And in 2026, new financial habits are quietly destroying credit profiles faster than ever before. Meet user zero. He did everything wrong, closed cards to be responsible, used buy now pay later apps, applied for rewards cards chasing points, never missed a payment, still got denied. Today, he's explaining the 3 fatal mistakes that nearly cost him homeownership, because once you see them, you can fix them. Let's start with the biggest trap Americans fall into. Mistake 1, the utilization trap. Most Americans believe one sentence: you're safe if you stay under 30% utilization. You've heard it. Finance blogs repeat it. Friends repeat it. Even bank apps sometimes hint at it. But here's the truth. 30% isn't a goal. It's a warning sign. Let's break the math down. Say you have one credit card, $10,000 limit. 30% means carrying $3,000. Sounds responsible, right? Wrong. Because modern scoring models compare you against other borrowers. And top-tier borrowers? They don't sit at 30%. They sit between 1% and 10%. Banks see utilization differently than consumers. You see spending? They see dependency. If you constantly need 30% of available credit, algorithms assume stress, especially during inflation cycles. Remember, credit scores aren't moral judgments, they're probability engines. Now meet user zero. He earns good money, pays every card on time, carries $4,000 balances across multiple cards, never late, feels responsible. Then he applies for a mortgage. Denied. Why? Because every reporting cycle showed high balances. Here's the secret most Americans don't know. Credit cards report balances before you pay them, usually when statements close, not when payments clear. So even if you pay in full every month, your report might show 40% usage, and lenders never saw the payment. Now add modern American life, groceries, streaming services, gas prices, emergency vet bills, balances creep up. And suddenly, your perfect payment history doesn't matter because utilization counts for nearly 30% of your FICO score. Let's talk about the 10% rule. Top borrowers treat credit cards like debit cards with strategy. They do 3 things. First, they pay before the statement closes, not after. Second, they spread spending across multiple cards. Third, They keep one card reporting a small balance. Yes, zero balances everywhere can actually drop scores slightly, because scoring models want activity, not dormancy. User Zero learned this late. He maxed one rewards card chasing airline miles. Utilization hit 82%. Score dropped 90 points. No missed payments, just math. And here's where Americans get hurt most. High utilization doesn't just lower scores, it raises interest rates automatically. Credit card companies run periodic reviews, higher risk signals, higher APR. That 19% card becomes 27%. Suddenly, minimum payments barely move the balance. Debt snowballs. So, what's the fix? Simple, but disciplined. Pay early. Request limit increases annually. Avoid closing cards during payoff periods. And remember, credit limits are leverage, not temptation. Because the first fatal mistake is looking responsible while appearing desperate to algorithms. But the second mistake is even worse because it feels like progress. Mistake 2, the silent credit killer. This might shock you. Closing a credit card can hurt your credit more than keeping it open. Americans love closure. Paid off debt? Cancel the card. Feels clean. Feels mature. Feels responsible. Banks? They hate it. Here's why. Credit history length matters. It tells lenders how you behave long term. Your oldest account is like financial DNA. Close it. You shorten your track record. Imagine applying for a job. One resume shows 10 years experience. The other shows 2. Same person, different impression. That's what happens when you close old accounts. But that's only half the problem. The bigger damage? Utilization shock. Remember the math. User Zero had $30,000 total credit limits. Balances totaled $3,000. Utilization? 10%. Excellent. Then he closed 2 unused cards worth $20,000 limits. Now, same debt. New limit total? $10,000. Utilization jumped to 30%. Score crashed without spending a dollar more. Mistake 3, the 2026 factor. You've seen it? Check out online. Sneakers, furniture, electronics. 4 payments, no interest. Buy now, pay later. Feels harmless, feels modern, feels smarter than credit cards. Until it isn't. In 2026, lenders started integrating BNPL behavior into risk analysis because missed installments skyrocketed after inflation spikes. User Zero used 5 BNPL services simultaneously. Shoes, laptop, holiday gifts, furniture, gym equipment. Each payment tiny, individually harmless. Together, chaos. Payments scattered across apps, due dates everywhere. One missed auto withdrawal, reported late. Score dropped again. Here's what Americans don't realize. Some BNPL providers now report activity to credit bureaus. Others don't. That inconsistency creates uncertainty. Banks hate uncertainty. Multiple BNPL loans look like hidden debt, especially during mortgage underwriting. Underwriters now request bank statements. See recurring BNPL charges. Questions begin. Debt to income recalculated. Approval delayed or denied. The Golden Path Recovery Plan. If your credit score already dropped, relax. Scores recover faster than most Americans think. Here's the 6-month recovery blueprint User Zero followed. Step 1. Lower utilization immediately. Pay balances before statements close. Target under 10%. Even temporary payments help. Step 2. Stop applications. No new cards. No unnecessary loans. Let inquiries age. Step 3. Audit reports. All 3 bureaus. Highlight errors. Dispute online. Document everything. Step 4. Piggyback strategically. Become an authorized user on a trusted family member's long-standing card. Low utilization, perfect history. It can add depth instantly. Step 5. Balance transfer wisely. Move high, upper balances to promotional offers. Reduce interest pressure, but avoid closing original cards. Step 6. Automate perfection. Every bill. Auto-pay minimums at least. Late payments are nuclear damage. User 0 followed this system. 6 months later, 610 became 720. Mortgage approved. Credit scores aren't about wealth. They're about signals. Consistency beats income. Strategy beats hustle. And the difference between denial and keys to your first home might just be understanding the invisible rules nobody taught you. If user 0 can rebuild from disaster, so can you. Because the American dream isn't gone. Sometimes, it's just waiting for your credit score to catch up.